All right, let's get straight into it. We're putting Lanka IOC under the microscope for a full financial autopsy. No fluff, just the hard numbers.
And boom, right out of the gate, we've got a massive contradiction. You see, their reported profits, it's down over 16%. But at the same time, their operating cash flow is a whopping 19.8 billion rupees. So what's going on here? How on earth is a company with shrinking profits absolutely swimming in cash?
And this is where it gets really wild. We're not talking about a small gap here. For every single rupee they claimed in profit, they actually brought in 3.76 rupees in cold, hard cash. Think about that. It's a huge signal that the real story, well, it's definitely not on the income statement. Now, let's be crystal clear about something. This is a forensic breakdown, not a buy signal. We're just here to dissect the numbers, not to tell you what to do with your money. Okay, so let's play detective. Where did this absolute mountain of cash actually come from? Because it sure wasn't from selling more fuel. The answer, my friends, is hidden in something called working capital. Now just think of it as let's say, the financial oil that keeps the gears of a business turning day to day. It's all about the short-term stuff, what you own versus what you owe. And this is exactly where Lanka IOC pulled a rabbit out of the hat. So how exactly did they do it? Well, here's the thing. They didn't earn this cash. They unlocked it. They basically found it hiding in their own balance sheet. And here is clue number one. Check this out. In just 6 months, their inventory, the actual fuel sitting in their tanks, dropped by almost 36%. They just went and aggressively sold off what they already had on hand. And the impact? Oh, it was huge. That one move, just selling down inventory, turned physical fuel into 15.7 billion rupees of cash, just like that. That right there solves most of the puzzle we started with. Okay, so here's how it all adds up. They also got better at collecting their IOUs, which brought in another 5.3 billion. On the flip side, they paid their own bills faster, which sent 6.7 billion out the door. So when you do the math, what are you left with? A massive pile of cash that came almost entirely from cashing in their working capital. On the face of it, this looks like incredible operational efficiency. I mean, turning stuff you own into cash that fast, that's seriously impressive. But, and this is a big but, this is a one-time trick. You can only sell your inventory down so far before you have nothing left to sell. You can't just keep doing this every year. Sooner or later, that well is going to run dry. All right, so if that gusher of cash is only temporary, we have to ask the next logical question. What about the permanent source of cash? The actual core business. And, well, here's the problem. While all this financial magic was happening on the balance sheet, the actual business of selling fuel was quietly shrinking. Revenue is down almost 10% from last year. So what's the takeaway here? It's pretty simple, really. The working capital party is over. From this point forward, if they want more cash, they have to earn it the old-fashioned way, by selling more stuff. That lever's been pulled. Okay, time for our next big pivot. Let's circle back to that profit number, the one that was shrinking. What is it even made of? Is it what you'd call high-quality profit? And this is a real shocker. Get this, almost half, 46%, of their net profit had nothing to do with selling fuel. Nothing. It came from something called finance income, which is basically just interest they earn on that huge pile of cash we've been talking about. So their profit is almost as dependent on interest rates as it is on their actual business. So that leads to a pretty scary question, right? If nearly half your profit just comes from interest, what happens to your business when, not if, but when interest rates fall? Suddenly, that whole profit engine looks incredibly fragile. And yet, here's the great paradox. Despite a shrinking business and some pretty fragile profits, this company is, financially speaking, an absolute tank. Unbelievably strong. I mean, just look at these numbers. For every rupee they have to pay in the near future, they have 3 rupees ready to go. They're practically debt-free. Debt is less than 5% of their equity. And they make enough money to pay their interest costs almost 30 times over. It doesn't get much safer than that. They're financially bulletproof. So let's tie this all together. What we have here is a company that has built an absolutely impenetrable financial fortress. But that fortress is protecting a kingdom whose borders are shrinking year after year. The strength is real, no doubt about it. But the purpose of that strength?
that's becoming a little less clear.
And that really brings us to the heart of the matter. For a company like Lanka IOC, the question isn't, can they survive? It's, can they stay relevant? If you value signal over noise, join the circuit.